Over the past quarter, there's been a remarkable thing to markets, which is that they've been rather calm. And after the year that we've just had, that's sort of a bit of a new thing. Now, when we compare, for instance, the Australian market via the ASX 100, we saw returns of about 8.9%. And similarly, on global indexes such as the MSCI All World, we saw 8.9%. So it has been a relatively calm and stable environment. When we consider all the indexes that we follow, it was, and that includes all asset classes, it was really only the Japanese Nikkei 225 that saw a negative return over the period. In its broadest sense, responsible investing can cover many different areas, but to make it simple, I'd like to break it into four key areas. So at the most simple, you have ESG investing, which is your environmental, social, and governance investing, which is something that has been done for a very long time. Next step along, you've got what is called negative screening, which is where you're really looking to avoid certain sectors, say tobacco industry or fossil fuels. You then have your positive outcome type investing, where what you're really trying to achieve or what you're trying to achieve in conjunction with your investment returns is some sort of social good, whether that is cleaner energy or avoiding obesity, etc. And then at the strongest end of your responsible investing, you're talking about what we call impact investing, which is a little bit of a tricky area. That there are some examples of where it's been done well in the past, but it does very much borderline just on pure philanthropy. So some of the things that are presented as impact investments are actually more like donating activities where you might be lucky to get the capital back after some good's been generated. If an organization is interested in getting involved in responsible investing, in the first instance, they should consider the purpose of their organization itself. Whilst this topic is a very emotive topic for many individuals, there is a risk that an investment committee of a not-for-profit could overreach and move away from the underlying goals that the money is actually there for in the first place. And what that could bring with it is legal risk or indeed more of a difficult approach to fundraising in future. And so the real crucial way to think about it is what does the cause of my organization allow me to do, and indeed what does it license me to do, and then the next steps is making sure that your investment approach aligns with that. Back in the early days, it was almost an assumption that you would forego returns by going down the responsible investing path. Now, of course, there are different ways to approach it, and so it really does depend on which path you take, whether it be the ESG screening side of things or the impact approach. But we know from meta studies, which are of course studies of studies, that when applying an ESG approach, you're actually more likely to get either the same returns, or it's in some cases even better returns. And of course, that actually stands to reason, because what ESG really entails, and again, that's the environmental, social, and governance aspects, it really just entails a closer look at how a company is being managed. And therefore, it really just means you're looking at a deeper level of due diligence. The outlook in markets for 2021 is actually reasonably positive. The combined backdrop of low interest rates and continuing government support is one that really does bode well for risk assets such as equities. Outside of any sort of systemic shock or a bout of vicious inflation, and by that there are certain forms of inflation that can be difficult to tame and might alarm authorities, but they are rare and not considered to be high probability. The environment is actually quite positive for share markets in general. It's really quite an encouraging time to be involved in responsible investing and indeed ESG. It's one of the things that has drawn our attention is the fact that we're now seeing people who aren't necessarily ESG or responsible investors investing in those sort of investments, because what they're seeing is a growing trend, and that sort of critical mass or gravitas then drives its own momentum for those sorts of assets.